Hey guys, welcome back to another episode of Smart Risk. In this episode we are going to show you one of our advanced scalping strategies in 1 minute time frame, based on the smart money concept, which is so accurate and insanely profitable that will take your trading to the next level. Like the other scalping strategies, we will not use indicators as entry reasons to execute a trade. Instead, we are going to use them as confirmations of our entries. So just forget the other nonsensical scalping strategies which just use indicators, and get full concentration to apply this advanced scalping strategy in your trades, which is definitely profitable and trustable. So make sure to watch this video all the way through, because I am going to explain this strategy in detail and give you a bunch of important trade examples. As always, to show your support, please be sure to click the subscribe button and turn on the notifications bell, so that you are alerted as soon as new content is released. So traders, let's get started. So again, before we go into the details of the strategy, you need to know the definition and application of these topics. All of these topics except the RSI indicator are parts of the smart money concept that we have explained in detail in previous episodes. If you don't know them yet, to fully understand these topics, go through our channel and watch our previous videos, which are linked in the description, but let us have a brief explanation of each one. So, starting with the order block. Order blocks are optimized supply and demand zones. They form when a large amount of money enters the markets by central banks or large financial institutions, which results in massive moves. In other words, they form when there is an imbalance between sellers and buyers. So, let me show you how to indicate an order block. In the bullish scenario, the last bearish candlestick before the start of a heavy bullish move is detected as the order block zone, or the first weak bullish candlestick before the drastic move. The same concept applies to the bearish scenario. So, let's move on to our next topics: break of structure and change of character. Imagine a trending market with a series of higher highs and higher lows. In this case, each of the highs and lows is the market structure levels, and the most recent higher high and higher low is the ones we monitor. Breaking the last higher high to the upside shows that price tends to continue to the upside, which we consider as a break of structure. In contrast, if price breaks the recent higher low to the downside, it shows that the price wants to change its direction, which we consider as a change of character. The key point is that a break of structure is valid, even if a shadow breaks above the previous structure level. But for a change of character, we definitely need to break and close below the previous market structure level. So we have discussed what we needed from the smart money concept. Now let's take a quick look at the RSI indicator and its features. So, starting with the basics. What is the relative strength index? RSI is a momentum indicator used in technical analysis, which measures the speed and magnitude of a pair's recent price changes to evaluate overvalued or undervalued conditions in the price of that pair. So, what are the RSI indicator's major features? The RSI indicator has two major features that make it more important. One, it shows the overbought or oversold regions in the chart. In other words, when the RSI indicator crosses 30 on the RSI chart, it is a bullish sign, and when it crosses 70, it is a bearish sign. 2. It indicates the potential divergence possibility in the market. An RSI divergence occurs when price moves in the opposite direction of the RSI. In other words, a chart might display a change in momentum before a corresponding change in price. There is two scenarios for RSI divergence. First is the bearish divergence. A bearish divergence occurs when the RSI creates an overbought reading followed by a lower high, which appears with higher highs on the price. This may indicate rising bearish momentum, and a break below overbought territory could be used to trigger a new short position. Let's understand this with the help of an example. Look at points A and B on the price chart. Those points are two swing high points. If we draw a line between points A and B, we can clearly see the price is making higher highs. Now, look at the corresponding A and B points on the RSI chart. Those are two swings high on the RSI chart. Here again, we draw a line between A and B, and we would see the RSI is making lower highs. So, the RSI shows us a bearish divergence signal. Second is the bullish divergence. A bullish divergence occurs when the RSI displays an oversold reading followed by a higher low, which appears with lower lows in the price. This may indicate rising bullish momentum, and a break above oversold territory could be used to trigger a new long position. Now, look at the C and D points. Those points are two swing low points. If we draw a line between C and D, it is obvious that price is making lower lows. Now, look at the corresponding C and D points on the RSI chart. Those are two swing low points on the RSI chart. Here, again we draw a line through C and D, and we would see the RSI is making higher lows. So, the RSI indicates a bullish divergence signal. Now guys, you know all of the topics that we will need in the application of our scalping strategy, so let's dive into our scalping strategy. This strategy has 4 major steps that you must follow them. 1. Analyze market structure in 15-minute time frame and draw in order blocks and wait for price to reach it. 2. Going through in 1-minute time frame and wait for price to form a change of character, then draw in new 1-minute order blocks and wait for price to get to our 1-minute order blocks. 3. Analyze RSI indicator in 1-minute time frame, looking for divergence signals as a confirmation for our entry. Step 4. After validation of all steps, we will place a trade in 1-minute time frame. So guys, let's try these steps on the price chart. So, here in the Euro-US dollar 15-minute time frame. In the first step we should analyze the market structure and draw on the most recent order blocks. As you can see, we have an uptrend with these recent green candles, which generated an imbalance and break of structure. So we can clearly spot this perfect order block zone right here, where price potentially can get rejected and provide us with a trading opportunity. Now, all we have to do is wait for price to reach the order block. As you can see, price entered the order block zone. So in the second step, we should zoom into our 1-minute time frame and wait for price to form a change of character. Then we will draw in a new 1-minute order block. As you can see here, in our 1-minute time frame we are facing a pretty strong downtrend, that price finally reached our 15-minute order block. So in the second step, price must show us a change of character. If price could not make a change of character, then we will have no trade. So for forming a change of character, price must break and close above this area, just like this. Forming a change of character by price here indicates that price is no longer in a downtrend, and it can potentially change its direction. So next, we should spot the new 1-minute order block. As you can see here, this zone is an order block that is generated by the movement of the change of character. So now in the third step, we should analyze the RSI indicator in 1-minute time frame and look for potential divergence signals as a confirmation for our entry. So, here we added the RSI indicator to our price chart. Now, look at the A and B points. If we draw a line between them, it is obvious that price is making lower lows. Now, look at the corresponding A and B points on the RSI chart. Here, again we draw a line through A and B, and we would see the RSI is making higher lows. So the RSI indicates a bullish divergence signal, so we have the confirmation for the entry that we were looking for. So guys, in step 4, we should place our order in the order block area. Let's take a closer look at our last step. We place our order here, a spread size above our valid 1-minute order block, with stop loss being a couple of pips below the lowest point of the area. In this scenario, with 1.5 pips spread on the Euro-US dollar pair, our stop loss is roughly 5 pips. For the first take profit, you could close half of your position when price reaches your 1 to 2 targets. This way, even price drops and hits the stop loss, you are still at break even. And for the second take profit, you could target the next major level of structure in front of the market in the 15-minute time frame. Or you could also keep track of your profits, meaning that every time price makes a higher low, you move your stop loss couple of pips below the lowest point of the higher low. Also, we can look for further entries as price keep going upside. Every time that price forms a new order block, we can place a new order with a lower risk. For example, as you can see here, price forms another order block, which is generated by a BOS, so we place a new order right here. Again, we have another order block, so we place a new order here. As you can see, price did not activate our third order, and we missed that trade. So let's continue. Again, price created an order block here. So we set another order here. As you can see, price activated our third long position. Placing orders after orders is optional, and you should never do it until you have gained sufficient skill and confidence. Always keep in mind that whatever position size you risk for the change of characters order block, you must risk half of that amount for the next trades. In addition, never have more than 3 open positions for the same analysis for a pair. Let's look at some more examples now. So, this is the US dollar Japanese yen. As you can see, we have a strong downtrend with these recent big red candles, which generated an imbalance and break of structure. So we can clearly spot this perfect order block zone right here, where price potentially can get rejected and provide us with a trading opportunity. Now, all we have to do is wait for price to reach the order block. As you can see, price entered the order block zone. Next, we're going to zoom into our 1-minute time frame. As you can see here, in our 1-minute time frame, we are facing a pretty strong uptrend that price finally reached our 15-minute order block. So in the second step, price must show us a change of character. As you can see here, price breaks and close below this higher low, with a big red candle. Forming a change of character by price here shows that price is no longer in an uptrend, and it can potentially change its direction. So next, we should spot the new 1-minute order block. As you can see here, this zone is an order block, which is generated by the movement of the change of character. So, now in the third step, we should analyze the RSI indicator in the 1-minute time frame and look for potential divergence signals as a confirmation for our entry. So, here we added the RSI indicator to our price chart. Now, look at the A and B points. If we draw a line between them, it is obvious that price is making higher highs. Now, look at the corresponding A and B points on the RSI chart. Here, again, we draw a line through A and B, and we would see the RSI is making lower highs. So, the RSI indicates a bearish divergence signal. So, we have the confirmation for the entries that we were looking for. So, to the next step. As our last step, we should place our order spread size below our 1-minute change of characters order block, with stop loss being a couple of pips above the highest point of the area. And we set our take profit margin at this major level. In this scenario, with 2 pips spread on the USD-JPY pair, our stop loss is roughly 7 pips, and our potential reward is 45 pips. So our risk-to-reward ratio is more than 6. Now, we see that price forms a BOS and new order block here. So without removing our first order, we place another order with less size. Let's see what will happen. As you can see, our second order's stop loss is hit by price. Then price activated our first order and changed its direction to the downside. So let's continue. As you can see, price again forms a new BOS and an order block right here. So we place a new order. As you can see, our third order has been activated and price makes a new BOS and another order block here. So again, we place an order here. As you can see guys, price activated our last order and hit the take profits of our 3 open trades. We lost a modest amount of our capital during this trading session, but our winnings much outweighed our losses. Always remember guys, never terminate your trades before price reaches your targets. So that's it traders. If you enjoyed the video and want us to keep making more videos week after week, please be sure to click the subscribe button and turn on the notifications bell. Also in the comments section, let us know your opinions and tell us what kind of topics you want us to cover, and we'll work our best to create more videos for you. So thanks for watching and we'll see you in the next episode.